Hey traders, welcome back to another session of Trade Like Assad. In today's video, we'll discuss institutional funding candles, a crucial concept that uncovers the hidden manipulation driving market movements. These candles represent the footprints of big players, and understanding them allows you to position your trades with smart money instead of falling into their traps and becoming a victim of manipulation. But that's not all. I'll also reveal a powerful trading framework centered on institutional funding candles that can significantly boost your win rate. So, make sure you watch this video till the end as we'll break it down step by step, giving you the tools needed to fully master IFC candles. We always value your support, so don't forget to hit the like button and subscribe to the channel if you're new here. See you right after the intro. Welcome back, trader. Let's dive right in. We all understand that market manipulation is real and will always be present. Institutions and smart money are usually the driving force behind this manipulation, which often results in losses for many retail traders. But here's the important part. The market is fractal, and smart money can never fully conceal its footprints. As a smart money trader, your objective is to detect these footprints so you can align with institutional flows instead of ending up on the wrong side, which typically causes losses. One of the most reliable ways to track these footprints is by accurately identifying institutional funding candles, IFCs. These candles reflect manipulation setups in the market, and analyzing them correctly gives you a sharp edge in forecasting the market's next movement. Now, let's begin with the fundamentals: what IFC candles are and how to spot them on a price chart. So, what is an institutional funding candle? An IFC is a candlestick, or sometimes a sequence of candles, that wipes out visible liquidity above or below a significant structure. These candles are created during manipulation phases, where liquidity gets removed right before a sharp move occurs in the opposite direction. Put simply, an IFC happens when price sweeps a critical structure and then swiftly pulls back into the range of that structure before continuing in the direction intended by smart money. To recognize an IFC on the chart, follow these steps. First, locate candles with unusually large bodies or extended wicks that stand out clearly. Next, watch for a sweep either above or below a key level. This is where liquidity is taken before price turns. Finally, confirm the reversal with strong displacement in the opposite direction, signaling a clear shift in market structure. Why are IFC candles important, and how can we apply them? IFC candles are vital because they capture the footprints of smart money within the market. These candles manipulate price action by sweeping retail traders' positions and highlighting areas of heavy volume just before a sharp reversal in the opposite direction. They outline zones where smart money intentionally steps in to remove liquidity and later re-engages their remaining positions. When price returns to these zones, it frequently reacts and reverses. Take, for example, a typical accumulation setup you'll often notice in the market. Price consolidates between a defined high and low, acting as solid resistance and support, with multiple rejections at both ends. Then, price breaks below support with a large bearish momentum candle, sweeping liquidity beneath that level. Immediately after, it rebounds above the support area with a bullish engulfing candle and surges quickly toward the buy-side liquidity resting above resistance. It's important to note that the liquidity below support contains two order types. Stop-loss orders from traders who went long within the accumulation zone. Sell stop orders from traders anticipating a downside breakout. Because price passed through a manipulation stage, an IFC candle is connected to this move. In this case, the large red candle represents the last bearish push that cleared sell-side liquidity before the sharp bullish reversal. From an SMC perspective, the psychology of IFC candles differs from standard models like consolidation or accumulation phases. Unlike traditional AMD patterns, all you need to confirm is when price sweeps liquidity above or below a supply or demand zone and then closes back inside that zone. This signals manipulation and highlights a high probability setup. For instance, in this scenario, price sweeps liquidity below the most recent swing low in its demand zone, then instantly shifts direction and moves toward buy-side liquidity, aligning with the broader market trend. IFC candles commonly form in such environments, creating trade opportunities in two key stages. After liquidity is taken from one side, price typically drives toward liquidity on the opposite side. These candles can be treated as critical areas, similar to supply or demand zones, with a strong likelihood of price reacting and reversing when revisited. Now, let's move forward into the details of my preferred trading plan for working with IFC candles. In a bullish market environment, if price dips below a significant low in its corresponding demand zone on a higher time frame, creating a potential IFC candle, and then immediately pulls back into the demand zone range, this acts as a critical signal. At this stage, we should quickly shift down to a lower time frame to study price action in detail and search for reversal clues and possible trade setups. Once an IFC candle is spotted and manipulation is confirmed, we can look to execute a trade. For entries, there are two approaches to consider. The first entry model is to wait for price action on the lower time frame to form a PD array, most often a mitigation block, before opening a trade. In this case, we're looking for a buy setup. Place the stop loss a few pips below the PD array. For take profit, you have two choices. Either target the nearest draw on liquidity visible on the current time frame or aim for a higher time frame draw on liquidity for larger potential returns. The second entry model involves using the higher time frame IFC candle directly. Wait for price to reach either the high or low of the IFC candle, then place a limit order at the 50% Fibonacci retracement of that candle. In this scenario, a buy limit order. Again, position your stop loss a couple of pips below the IFC candle itself. Now, let's move over to a live chart example to put these concepts together and demonstrate exactly how to use them in real trade execution. Here we have the Euro-Dollar 30-minute chart shown on the screen. As you can see, the overall market profile is bearish because price has produced multiple bearish breaks of structure to the downside. Looking more closely, you'll notice that price grabbed the buy-side liquidity above this major high with a strong engulfing candle during the move up. It also swept the liquidity resting above these equal highs. After clearing that liquidity, price has now returned below the range of the major high. This candle is a strong candidate to be classified as an IFC candle. The next step is to mark the highest and lowest points of this 30-minute IFC candle. Then I'll drop down to a lower time frame, in this case, the 5-minute chart, to look for confirmations and entry setups. Now, with the 5-minute chart visible, the objective is to patiently wait for price to produce both a market structure shift and a 5-minute PD array. Once these criteria are in place, we can look for a short entry from the 5-minute PD array. As you can see, price continues its decline, further validating the IFC candle. Here, we can observe that price has created a market structure shift and formed a PD array, which in this situation is a mitigation block. The sequence is straightforward: a swing high, followed by a swing low, then a lower high, and an immediate drop. It's critical to understand that this is not a breaker block, since a breaker requires price to form a higher high instead of a lower high. These final two down close candles form the 5-minute PD array, which is the mitigation block. I'm placing my entry at the lowest point of that mitigation block and setting my stop loss just above this swing high. For take profit, there are two choices. Target the nearest 5-minute sell side liquidity located here, or target the 30-minute time frame sell side liquidity located over here. I'm choosing the more aggressive option by aiming for the 30-minute swing low, which provides roughly an 8-to-1 risk to reward ratio. Now let's play out the trade and see how it unfolds. As you can see, my order has been activated and price is moving downward with strong momentum. Eventually, price reaches the take profit level successfully. Now, let's move on to another example to reinforce this concept. To reinforce this concept, once again we're looking at the EUR 30 United States dollars minute time frame on the screen. As you can see, there's a large engulfing candle that clears the liquidity above the previous major high. This engulfing move is a strong candidate for an IFC candle. I'll mark its highest and lowest points, then switch to the 5-minute time frame to look for possible reversals and confirmations. On the 5-minute chart, we now need to wait patiently for price to return into the IFC candle's range, which would confirm that a manipulation phase has taken place. As you can observe, after sweeping the buy-side liquidity above the major high, price quickly reverses and drops back into the highs range. This gives us the confluence we need. For added confirmation, I'm going to wait until price reaches the lowest point of the IFC candle before taking further steps. Now that price has tapped the lowest point, I'll apply a Fibonacci retracement to the IFC candle and set a sell limit order at the 50% level. My stop loss will go just above the candle's high. For the take profit, I'll target the next sell side liquidity below this swing low, offering around a 4-to-1 risk to reward ratio. As you can see, the order has been activated and we're now in the trade. In the end, the setup played out successfully and price reached the take profit level. That's all for this session. Traders, thanks for tuning into the video. I hope you found the content insightful and practical. Make sure to subscribe and enable notifications so you don't miss any of our upcoming videos. We always appreciate your thoughts and suggestions, so feel free to share your feedback in the comments and let us know which topics you'd like us to cover next. Your support means a lot, and we'll see you in the next episode.